Hello everyone. So today we'll be discussing the volatility index on what to expect from volatility index. So looking at the volatility index from a daily time frame, we were actually at the beginning looking to take long positions around this area where we've seen the market make an extension pushing price to the downside, resulting in the formation of an excess price. As you can see, we are in a bit of a consolidation, a daily consolidation, which started beginning of the year. So we are in a 7 months consolidation basically. So right now what we'll be looking at is that we'll be looking for potential long positions in order to push the price a bit further to the upside. So what we can see right now, we can see that the market has formed a head and shoulder pattern. So we've got an inverse head and shoulder pattern, which is something that will help us in terms of determining when to buy or when to look for a long position opportunity. So we've seen the market pushing a bit further to the downside, whereby it just rejected the 50% Fibonacci retracement level, which confluences with the retest of the 4-hour demand zone, and then the market just kind of like pushed a bit further to the upside. But remember that, like, based on the Dow theory, the market is still considered to be in a downtrend up until a recently formed high has been broken. So from this perspective, our recently formed high is this area here. So till we break above this area, we will still regard the market as being in a downtrend, right? So, and then again, when we view it from this area, the market will be considered to be in an uptrend up until we break below this recently formed swing low. So right now what we'll be looking at is that we'll be looking for a potential fill of this area here that has been unfilled. So we've got this price level here that hasn't been filled yet. If you can look at it from a daily time frame based on the volatility index trading view, we can see that there is a bit of a gap similar to here. We had a gap, market gapping a bit further to the upside. What we'll be looking at is that we'll be looking for the fill of this gap, pushing the price to the downside, and then also filling this gap as well. So the fill of the gap, it will also confluence with the retest of the daily demand zone. So we want to see this daily demand zone being filled. So when the market pushes a bit further to the downside to fill this area here that was unfilled before, what we will end up seeing is that we'll end up seeing the formation of a right shoulder. So this will give us a basis of where to take our long positions, and then kind of like provide us with a proper risk to reward ratio. Definitely we'll be looking for a potential long position on a lower time frame, because we need to try our best to minimize risk as much as possible by maintaining a proper risk to reward ratio. So for instance, if I'm risking $1, I expect to make $6 out of that risk that I've taken. So we do know that this will be, for now, we will have different confluences. There will be a retest of the 4-hour 61.8 Fibonacci retracement level, which also confluences with the retest of the daily demand zone, and also the retest of the inner demand zones that we'll find while analyzing the market from this high time frame towards the lower time frame in order for us to look for entry. Remember that in the market, we've got things that we call multiple time frame analysis. So multiple time frame analysis is actually divided into two, where you've got your top-down analysis in attempts to look for an entry and minimize your risk. And then you've got something called a bottom-up analysis, where you have made your execution, you have already in a position, or you've made an entry. So you're looking for opportunities to scale in, add more position as the price is moving to the upside, or make a decision on whether to close your position or keep your position, adjust your stop losses, move your stop losses to break even, or move them a bit further to your entry point, or just minimize risk by moving them a bit closer to your entry point. So those are things that we need to be in the lookout for. And then again, when you do bottom-up analysis and top-down analysis, when you combine them and you're already within a trade, it can give you an opportunity for you to look for hedging positions where you hedge against your when you hedge against your recently entered positions as well. So basically, hedging is just a method of just minimizing your risk within your positions as well. So now let's move to a 4-hour time frame. So by moving towards a 4-hour time frame, remember right now we're doing something called top-down analysis, right? We're doing something called top-down analysis in attempts to find our entry. So now what we're seeing here is that we're seeing what the market has presented for us, right? So this is what we're currently seeing right now. So we see how the market has reacted upon the retest of this level, right? So if you can do something like this, then you start realizing that the market actually retested the 50% Fibonacci retracement level. So, but then again, we have to understand the reason why the market pushed to the upside. So now the push to the downside here, it will also confluence with the retest of the 61.8 Fib level. So I want to see the 61.8 Fibonacci retracement level being tested. So if that's the case, and this is what I want to see occurring, now first of all, you have to understand the reason why we had this push to the downside when the market was declining in value. So the push to the upside occurred due to what? The fact that we had something called a inverse head and shoulder pattern that formed around this area. This is one thing that led to the move pushing to the upside. So we have actually completed this level here. The only thing that will tell us that the market has no potential of pushing to the downside is if we break above this level. So a break above this level therefore will tell us that now we should be looking for a potential long position around this area here. But for now, for us to get long positions, we need to see the market declining in value to retest this area here, the daily demand zone, which also confluences with the retest of the level in which the market broke out of, the retest of the 78.6 Fibonacci retracement level and the 61.8 Fibonacci retracement level, the 4-hour Fib levels. So that's the one thing that we're looking at. So now if is that's the one thing that we're looking at, or that's something that we're currently looking at. So now let's do this. So now when we're looking, if that's the case of what we're looking at, so now we'll review this market in terms of what? A potential double top. So this will be our potential double top. So if this is our potential double top, the completion of this movement will be somewhere around here. So there might be a potential tap into this area here to retest the 4-hour demand zone, which also confluences with the retest of the 1-hour demand zone, the daily demand zone as well. So that's the one thing that we're looking at, because like if we have a double top here, that means the completion of the double top movement is around this area here. So currently what I'm looking at is that I'm looking for potential shorting opportunities around this level. As soon as the market test the supply zone, I'll move to a lower time frame in order for me to get those short positions in place while minimizing my risk. So knowing that like if the market breaks above this recently formed swing high, then I will consider my short position as being invalid, pushing price to this level here. So I'll just be using risking effectively in order for me to just kind of like push price to the downside during the retracement and just get that opportunity as well. So now let's move to, before we even move further to that, if as you can see here, those that use trend lines to trade, they can actually see that the market actually broke below this trend line, right? Broke above this trend line. By breaking above this trend line, we have yet to retest the level in which we broke out of and also the trend line. So that's why I'm expecting a dip, a push to the downside before I can consider taking long positions, because as you can see here, the market is already high. And then we do know that whenever you're within a trade, you cannot buy from buyers. You can only buy from sellers, right? So right now what we need to do is that we need to see the sellers coming into the market for us to be in a position to consider buying, because now we will have someone to buy the volatility index from. Yes. So now let's move to a 1-hour time frame. So you see, when we move to a 1-hour time frame, the risk is being minimized. That's the most important thing. Whenever you are within a trade or looking to take a position, first of all, ask yourself the risk. How much are you willing to risk in, and how much are you making? Basically, you're talking about your risk to reward ratio. So right now what I'll be looking at is that I'll be looking for potential retest of this level. That's where I'll be looking for my potential short position, and then I'll push price to the downside. So my risk to reward ratio would be perfect. Right? There we go. So my risk to reward ratio will be perfect. So we'll be looking for potential bearish reversal candlestick pattern around that area. But again, don't focus on one time frame. Again, you can move to the 15 minutes time frame. Now you see when you move to a 15 minutes time frame, what do you get? You get this area here. So you can have the tap into that area there, the 15 minutes supply zone that was previously formed, which also confluenced with the retest of the 1-hour supply zone as well. There's the retest of the 15-minute supply zone, which confluences with the retest of the 15-minute supply zone. And all of those things, what they do is that they minimize risk. So the lower time frame that you move to, the more you minimize your risk. So now you've got a proper risk to reward ratio. So this is where I'll be looking to take my potential short position while maintaining a proper risk to reward ratio. But I'm not going to just jump into the trade when the market approaches that level, because I need to be in a position where I measure my momentum, the speed in which the market is approaching that area before I pull a trigger. I need to understand how fast the market is approaching that area as well. So if you have any question, just make sure that you send me a DM and then we will talk about it.